Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. This morning, the US released two significant macroeconomic indicators that have caught the attention of Wall Street. First up is the weekly jobless claims report, which revealed that the number of first-time applicants for unemployment benefits exceeded economists' expectations. Last week, 225,000 individuals filed for unemployment assistance, while economists had predicted only 222,000. Although the shortfall is minimal, it still presents a negative outlook. The second key data point is the ISM Services PMI, which came in substantially above expectations for September, reaching 54.9. Economists had generally forecasted a much lower figure of 52, making this a notable increase. However, it's worth mentioning that both of these figures are secondary in importance when assessing the overall US macroeconomic landscape. Today, the most pressing financial news that has captured the attention of major international financial media involves the escalating situation in the Middle East and its impact on global capital markets. According to a report from the Wall Street Journal, President Biden's comments regarding Israel's potential retaliation have led to a surge in oil prices. The report notes that Israel has vowed to strike back at Iran following missile attacks, with reports from Citigroup suggesting that any such retaliation could affect the supply of 1.5 million barrels of oil per day. When asked about the possibility of US support for an Israeli strike on Iranian nuclear facilities, Biden stated, "We're discussing this." This statement has led to widespread belief in the international capital markets that the US is essentially giving Israel the green light to attack Iran's oil infrastructure. Prior to this, the US had been working to prevent such actions. Biden's remarks immediately triggered a shift in the oil market, with West Texas Intermediate crude jumping 5.5% to nearly $74 per barrel. Meanwhile, global benchmark Brent crude rose to around $77. The ongoing crisis in the Middle East, particularly the confrontation between Israel and Iran, along with Iran's proxies in Gaza, Lebanon, and Yemen, poses a significant risk to global oil supplies, as this region accounts for about one-third of the world's supply. Traders are concerned that any attacks on energy infrastructure or disruptions to supply routes could have a substantial impact. Senior energy trader Abin remarked that energy infrastructure is now viewed as potential targets, a fact that doesn't entirely surprise the market. However, the prospect of Biden's comments making such military action more likely has raised eyebrows. There is skepticism about whether Israel will actually target oil facilities, largely due to the Biden administration's interest in stabilizing oil prices ahead of the upcoming elections. Market investors generally believe that the US government may intervene to prevent Israel from striking Iran's oil infrastructure or at least limit the scope of any such attack. Citigroup has released a report outlining two scenarios. A significant attack could reduce daily oil supplies by 1.5 million barrels, while a smaller-scale strike on Iran's downstream assets might cut production by 300,000 to 450,000 barrels per day. As discussions between the US and Israel are expected to unfold in the coming days, it appears increasingly likely that Israel will feel compelled to act. From my perspective, it's noteworthy that while Israel has targeted Iranian proxies in Lebanon, Yemen, Syria, and Gaza, it has not directly attacked Iran itself. Even high-profile operations, like the assassination of Haniyeh, haven't escalated into full-scale military action against Iran. In contrast, Iran has launched major missile strikes on Israeli territory twice already. If Israel continues to allow Iran to carry out significant missile attacks without response, it could jeopardize its future strategic security. The international capital markets seem to have largely factored in Israel's potential retaliation, but it remains to be seen if Israel will heed US advice to keep its response within a manageable range, as suggested by Citigroup's small strike scenario. I believe there's a strong chance of this happening. Today's second news in an interesting development reported by Bloomberg. Japan's wealthiest individual, Tadashi Yanai, CEO of Fast Retailing, has made a groundbreaking $31 million donation to the UCLA College of Humanities. This generous contribution marks the largest single donation the college has ever received. This isn't Yanai's first philanthropic effort toward UCLA. He previously donated $25 million in 2020. So, why is this news significant, and why is it attracting mainstream media attention? Large donations to humanities programs are relatively rare, as most major contributions typically go toward science and engineering departments. The question arises, why has Yanai chosen to allocate such a substantial amount to the humanities? Bloomberg further explains that Yanai's donation will fund a center focused on the study of Japan's past and present. The director of this center at UCLA emphasized that people can now explore what types of Japanese humanities books are being published worldwide and gain insights into global perceptions of Japan and current events unfolding there. From my perspective, this initiative bears resemblance to Chinese leaders' emphasis on promoting a positive narrative about China. However, Yanai's approach isn't about forcefully crafting a good story for Japan, rather, he aims to foster a deeper understanding of Japan among global audiences. Through this project, he hopes to enable Japanese people to see how the world views their country and its citizens. This method appears to be more palatable than the heavy-handed promotional efforts often associated with Chinese propaganda, potentially making it more acceptable to audiences. The third news I want to share today, in what might seem like a minor story to the average person, a recent report from Bloomberg highlights a significant development for those interested in China's economic landscape and US-listed Chinese stocks. The report reveals that Miami Dolphins owner Stephen Ross is in advanced negotiations to sell a stake in the NFL team to Ars management and billionaire Joe Tsai, with a deal valuing the franchise and associated assets at a staggering $8.1 billion. Joe Tsai, co-founder of Alibaba Group and a major player in the e-commerce space, has not yet responded to requests for comments regarding this transaction. So, why is Bloomberg paying such close attention to this news, particularly in connection with Alibaba? I believe this story sends a clear message to the market about Tsai's increasing investments in US assets, particularly in the sports industry. The connection is easy to draw, similar to how former Microsoft CEO Steve Ballmer invested his wealth into purchasing the Los Angeles Clippers. Tsai's move could indicate a strategic shift. Currently, Tsai is at the helm of Alibaba amid a period of turbulence for the company, which is facing challenges and in need of a recovery strategy. This situation could raise concerns about his commitment to Alibaba, especially as he diverts capital toward investments in the US. Such actions may not convey a positive signal to investors. One possible interpretation of this move is that Tsai and Alibaba founder Jack Ma may be strategizing to elevate Alibaba's stock price through certain maneuvers before cashing out. However, there's also the chance that Tsai believes his private investment should remain separate from his responsibilities at Alibaba, promising to focus entirely on enhancing the company. But if that's the case, one must question why he's increasing his investments in the US instead of bolstering Alibaba's prospects directly. Why not inject some of that capital back into Alibaba or support its stock buyback efforts? Regardless of the reasoning, this situation doesn't project a very positive image for Alibaba. Following the announcement, it's worth noting that US-listed Chinese stocks experienced a broad decline, with Alibaba suffering a slightly larger drop. This is a crucial moment for investors and anyone tracking the e-commerce landscape in China. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.